Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, Call of Duty maker Activision Blizzard is selling its business to Microsoft. Peloton gets pummeled. Peloton is suspending some production of their bikes and treadmills due to excessive inventory. And finally, Netflix releases their fourth quarter earnings yesterday. And if it was one of their shows, it would have been called Breaking Bad. We'll have that and more tonight on Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. I'm Andre Laborde. For this Friday, January 21st, 2022. I hope your week went well. And the week is over, and for anyone long the markets this week, well, the weekend couldn't get here soon enough. Coming up, we'll be having how the markets did for the week, but just to kind of give you a sneak peek, the S&P 500 and the NASDAQ had their worst week since October of 2020. Exercise bike maker Peloton is halting their production, according to internal documents. Peloton is going to be halting their bikes for 2 months, from February to March, and they don't anticipate producing any Tread Plus machines for the fiscal year of 2022. And also coming up tonight, we've got a great guest for you. James Glassman is the best-selling author of a couple of years ago with a great book called Dow 36,000. Now, he's written numerous financial columns from everything from the Wall Street Journal and the Washington Post and many more. Well, also, he's the former Undersecretary of State in the George W. Bush administration and former ambassador. Ambassador James Glassman was going to be with us in just a minute. But first, how did the markets do this week? Well, all three indexes ended much lower. And this week, the Dow Jones ended the week down 4.5%. And the S&P 500, they ended the week at 5.6% lower. And finally, the NASDAQ, they ended the week down 7.5% for the week. It was a bad one. There were no upgrades on stocks this week. I think every analyst all through there were so many stock sell-offs, they didn't want to stick their necks out, and there were so many more sellings than there were buying. So let's get to our guest. James Glassman has worn many hats. He was Undersecretary of State during the George W. Bush administration, also serving as ambassador. And now he writes numerous financial columns for the Wall Street Journal to the Washington Post. And he's the co-author of the best-selling book, Dow 36,000. And best of all, he's here with us tonight. Hi, Jim. Welcome to Wall Street Wrap-Up.
Thank you, Andre. Great to be here.
Jim, yeah, I was watching a C-SPAN show, and this was about maybe a good 10 years ago with Brian Lamb. And it kind of gives you an idea of, this was before I had a show. So this is what I did for fun, okay? And I remember you on.
What's C-SPAN?
Brian Lamb asked you, how much of the public, percentage-wise, owns stocks? And if I remember correctly, you said something like, at the time, it was like 50% of the public owned stocks. Now, that was about a good 10 years ago or so. Do you think today that there's still about 50% of the public own stocks?
So that's a great question, Andre. The answer, according to Gallup, as of last year, is 56% own stocks either individually, through stock mutual funds, through their retirement accounts. And incredibly enough, that figure actually has declined over the last 20 years, from 60% down to 56%. My feeling is that is still fallout from 2008, 2009. And, as a stock market evangelist, I would love to see that figure get a lot higher. I mean, it really should be 70, 80%.
Exactly.
But it is right now 56. Yeah. And I think that figure is all the more disturbing because of the tremendous changes that have made retirement investing in stocks so much more attractive. And those occurred in the 1970s and 1980s, but, they took a while to flow through. So those are, of course, IRA accounts and 401ks. And even so, you can see only, roughly half of families own stock. And actually, the figure is quite low for younger people. So among people under the age of 35, I think it is, only about 35% own stocks.
Hmm.
So it's low. And really, as you know, uh, owning stocks when you're young is about the smartest thing you can possibly do in your life. Because one thing we know about the stock market is while it is quite volatile in the short term, or can be quite volatile, over the long term, it's not volatile at all. And an investment in the stock market over a long period of time, 20 or 30 years, has consistently paid off. I just think that people should start investing on a regular basis in stocks, and I'm talking about small amounts of money, $100 a month, maybe $50 a month,
Hmm.
starting when they're in their 20s. And that builds up incredibly over time. And certainly if you start in your 20s rather than in your 40s or 50s, you'll have a lot more money thanks to the tremendous power of compounding.
What about, with inflation? Just recently, the Consumer Price Index came out with inflation for the month of December, year over year, from December of 2020 to December of 2021, is up 7%, which means that's the highest it's been in 40 years, since 1982. What type of erosion or what type of damage does inflation, you think, do to your stocks?
Well, there are very few places where you can hide when it comes to inflation.
Hmm.
But stocks tend to be a good investment for inflation because companies are able to raise, most companies anyway, are able to raise their prices. And historically, when we look at how the stock market is done in inflationary periods, it's done very well. Now, not in extreme inflationary periods, not like the late 1970s, but that was quite an anomaly. But if we're talking, first of all, I don't think we're going to have 7% inflation much beyond this year.
Hmm.
Certainly, inflation has come back. We've been in a period where we've had price increases on the order of 1 or 2%, and I think we're going to get back closer to the norm, which is about 3%. And look, at 3%, even at 3% in 25 years, the value of a dollar is halved, goes down by half, so that's significant. But stocks are really a very good place to be. Bonds, usually not so much. Commodities can be a very good place to be, but they're difficult to buy and to trade, and I certainly don't recommend that.
Companies can raise their prices. Companies many times have their dividends, and they can raise dividends. And you've got a company, and I'm just going to say Apple, but there are many others. Apple has consistently raised their dividend year over year. Snap-on Tools. Snap-on has, since 1939, has consistently raised their annual dividend every year, since 1939. Do you think that to break the back of inflation, I mean, you mentioned about the late 1970s, Paul Volcker was the Federal Reserve chair at the time when he broke the back of inflation by having to raise interest rates so much. Do you think that this Fed chair is going to have to start raising interest rates so much that it might look like 1979 all over again?
Uh, not in my opinion,
Okay.
but certainly, the Fed chairman will start to raise rates. He's already said that's going to happen next year and probably for several years after on I think, a fairly modest basis, maybe 3 or 4 times a year. So we're going to get back up to 3%, maybe 4%, but I don't think that's so bad. For one thing, that's going to encourage people to save. Now, it may make the stock market less attractive compared to the bond market for an investor. Right now, it's pretty hard to invest in bonds. You're only getting a 1 or 2% return from a treasury bond, so
Hmm.
that makes stocks more attractive. But for individual companies, and they're the ones that make up the stock market, and they're the ones that count after all, a little bit of inflation is not so bad at all.
Yeah. Do you think they waited too long before starting this raising of interest rates, or do you think that their timing was right?
No, I think
Yeah.
they waited too
Yeah.
long. So I don't think, based on the evidence that we have now, that we're facing a really terrible inflationary situation. But I do feel that the Fed should have started raising rates a little bit earlier. Yeah.
I'm curious, and I just would love your thoughts too. He wasn't renominated yet for his second term. Do you think Paul? I mean, you've worn hats in the financial world, you've worn hats in the political world, and you know, being a Fed chair is a pretty good job. Do you think that one of the reasons he was waiting because he was waiting to hopefully get renominated?
Possibly, but I think that this Fed chairman has done a very good job in resisting political influence. I mean, don't forget the way he was under, I would say, unprecedented attack by President Trump. And not that President Trump didn't have a legitimate criticism for this initial interest rate increase, although it was quite a small one. But he was under enormous pressure and really did not buckle under that pressure.
Jamie Dimon just recently said that he said the economy is very strong, but it's the market that is flaky right now. And I'm curious because, well, with supply disruptions, chip shortages, I mean, you can't make a cup of coffee these days with a Mr. Coffee without having a microchip in your coffee pot, or automobiles having problems with sales because of there's not enough because of the chip shortages. Do you think the economy going into 2022 is going to be seeing a slowdown?
So I think it's certainly possible that we're going to face a short-term slowdown because of Omicron.
Hmm.
However, in general, I think this is one of the strongest economies that this country has seen in decades. The economy is very, very strong. It's under constraints right now, which I believe are temporary. So, as you say, there's supply chain restraints. There are specific restraints as a result of a microchip shortage. There's some demand restraints as a result of people have being locked in their houses, not getting out to travel or to go to restaurants. We're still seeing clearly some fallout from the early part of the coronavirus pandemic, where people left their jobs in part through certainly an impetus, I would say, from some really generous and I think warranted government help, and then have been somewhat reluctant to go back to work. I think all that is going to be behind us by the end of the year, and we've got a tremendously strong economy. Let me just mention one reason it's so strong is productivity. That's what really counts. It's like making more with the same, or making more with less in the way of imports, labor inputs, capital inputs. Um, we are we're really clicking when it comes to productivity. Companies have adapted to the difficult situation that they're in. This always happens with a recession. They figure out how to do things with less, and that's going to carry over. So I am very, very optimistic about the U.S. economy.
You wrote a book a while back about 15 or so years ago with you and Kevin Hassard that people still talk about today. It's called Dow 36,000, bestseller. And at the time, when the Dow was at 11,000, you said Dow 36,000. Well, now Dow 36,000 is in our rearview mirror. You recently
Right.
wrote an op-ed for the Wall Street Journal that said Dow 1 million. And I thought it was a great article, a great op-ed for the Journal. Where do you see, like at the end of the year of 2022? I mean, we're just above 36,000. I mean, what do you think 2022? I mean, just adding on to what you were just talking about with the economy, will end up the year at?
So, Andre, let me just explain Dow 1 million for a second. So all I said was that that based on the past performance of the stock market, which I believe will carry forward and certainly has over the last 100 years, within 50 years, we'll get to Dow 1 million. We should get to Dow 1. I don't think I'm going to be around, but who knows?
I hope you will.
You're asking,
I hope we both will. Mhm.
thank you, thank you. It will definitely set a record. I beat that Japanese woman who's 118 or whatever it is. So, but okay, what will the stock market be like a year from now? I don't know. Is the real answer to that? I mean, I could say that it'll be up pretty much at the rate that it has on average over the last 50 or 100 years, and that's about 7 or 8%. So, that may happen. That would put it up to 38, 39,000 for the Dow. I think that's a pretty good bet. We've been really going wild in the last few years, and I don't think that's necessarily going to continue. But I do think it's important for people, and I'm certainly not criticizing the question. This is something that's on everyone's mind. But I want people to be long-term investors in the stock market, and so questions about what a particular stock's going to do in a year or next year or the market's going to do, I don't think that's something that should concern a typical investor. I think they want to know, look, if I make consistent investments or contributions to my IRA, over the next 10 or 20 years, what can I count on, or what's likely to happen? And I think what's likely to happen is something that's very, very good. Kind of for people who aren't in the market, I think they ought to be in the market.
Very true. If you're just joining us right now, we're so happy to have him, author, former ambassador, former Undersecretary of State, James Glassman is our guest. We're going to take a break right now, but don't go away because we'll be right back. And if you just joined us, we're very happy to have James Glassman with us in the Wall Street Journal, and we're talking about Dow 1 million on how for the long term. And I think in that article that you had for that editorial, you had something very interesting. You were talking about Benjamin Graham, and he said even then people have this hard propensity of just sitting and waiting alone of wait. So to sit and wait for the stock market to be gradually rising while it goes down, it goes flat, it goes up, it goes down. But over time, it becomes very hard. And I think even what you mentioned where Benjamin Graham even said that.
Patience is the greatest virtue in investing. I don't think there's any doubt about that. And Benjamin Graham said that the investor's own worst enemy is himself. Someone once said to me, and I think it actually was Kevin Hassett's wife, that the stock market rewards people who don't do anything. That is to say, it's really hard not to do anything, and you ought to get rewarded for that.
That's true.
And it's pretty much what Benjamin Graham is saying. I can tell you for a certainty that we're going to have periods where the market will drop not just 10%, but 20%, maybe 30%. We just saw that. Mm-hmm. We saw that with COVID.
March of 2020, the market dropped. Yeah,
March of 2020, Andre. Stocks dropped 30 or 40%. Here it was 6 weeks, and by the time you realized what was happening, it was starting back up again. So maybe it didn't crush the typical account where people bailed out the way that it did in 2008, 2009.
Sure. I think, in fact, Warren Buffett had a great line. He said you should have like a punch card, and you only have so many punches around the punch card, and that's how many stocks you're only allowed to buy or to sell, which makes it very judicious as far as like how many times you punch that card because you've only got X amount to do. That, in other words, for a buy and hold strategy. Jim, what about, I know I constantly, weekly, get people, friends of mine and such, who ask me about cryptocurrency, Bitcoin, and other types of, other types of currency such as that. Do you see that? I mean, it's not going to go away, Bitcoin or cryptocurrency, but do you see the federal government eventually going, no, we're going to regulate this?
Yeah, I think that's quite likely. Mm-hmm. I mean, my own view about cryptocurrency is that, in general, it's a pretty good idea. But the problem with it is that you want currency to be a fairly consistent store of value. And right now, it's not. You don't know what your Bitcoin is going to be worth a month from now. Whereas you got a pretty good idea what your dollar is going to be worth, even if inflation's 7%. You know that it's not going to lose 40% of its value the way that Bitcoin has in recent months. And so I think at some point the different cryptocurrencies will shake out, and there will be some stability. I frankly, personally, don't want to be in the market before that happens. And I'm glad some people are, but I think they got to understand that this is very risky at this point, and we certainly have seen it in the prices. Like take something like Dogecoin. I don't know whether you followed that, but wow! I mean,
Only from
the
afar,
prices.
Jim.
I mean, it's down now.
Only from afar.
It's down from 50 to 15 cents. Yeah, this is not my idea of fun, but
Yeah.
some people like it, and so
I mean,
good for them,
Charlie
but I would
Munger.
not put my retirement money into it.
True. We were talking about Warren Buffett a little while ago. Charlie Munger, his partner, said that one thing about cryptocurrency is that you're willing to buy something that you're hoping somebody is willing to pay you something higher for it at a later date, because it doesn't make earnings. It doesn't create an additional type of value. So you're only hoping that it would be
Right.
going up, eventually. Just recently, Elizabeth Holmes was found guilty of fraud with Theranos. Now, fraud with the stock market has gone way back since Jay Gould and Commodore Vanderbilt. So there's nothing new about fraud. But did it surprise you that so many smart people gave so much money? Rupert Murdoch from Fox News, Larry Ellison from Oracle, Betsy DeVos. I mean, they gave areas of $100 million to a company that was nobody really knew that much about, except, they were on the hope, on the come, that it was going to be something that would be helping mankind with blood. Did that surprise you?
Yeah, it did surprise me, but on second thought, there's a lot of money sloshing around, and there are a lot of people who would like to get in on the ground floor of something that's going to be increase in value by 10, 20, 30 times, and so they're making bets. And I think all the people that you just named are people who can afford to lose, even $100 million. And so they're placing bets. Now, clearly they thought that this was less speculative than it turned out to be. And also, I do think that there is a phenomenon, a very powerful one, where people look at, let's call them agents. They look at other people who have made decisions, and they say, "Wow, if Larry Ellison of Oracle is putting $100 million in, why shouldn't I? I mean, he's a pretty smart guy."
Look where we
So
got.
let me
I
get in on
completely
that
agree. I want to tell our audience that we're so happy to have you, but you have a New Orleans connection here. You, for a while, lived in New Orleans, and you were the publisher of Figaro newspaper. Is that right?
That's right. So I lived in New Orleans in the 1970s, from 1972 to 79. Both my daughters were born in New Orleans at Oxnard's, and one of them still lives in New Orleans. She has two lovely grandchildren. One of them goes to Jesuit, the other one goes to Dominican, and she lives uptown, and she loves New Orleans, and I love New Orleans. I come to New Orleans normally when there's no COVID, about 4 times a year. Yeah, and I started Figaro in 1972, along with two friends of mine, one named Jack Davis, who still lives in New Orleans. He went on to the States item that became the number 2 editor at the Times-Picayune, and as well as a guy named T. Nolan. T now lives in New York, and I do some business with T, but we started Figaro in 1972, and I left New Orleans in 79. I sold the paper, and but had a great time here.
Well, we're so glad to have you had that New Orleans connection. Jim, I got time for about one more question before this time, and
Sure.
I hope you come back with us. What's the best investment advice were you ever given? Or think of you talking to your grandchildren.
Well, I think the best investment advice for grandchildren is a little bit different from, I would say, the best investment advice I was ever given. So for them, I want to go back to what we were talking about before. For
Hmm.
them, the best investment advice is start investing as early as you possibly can and stick with it. I think I actually got some very good investment advice that I think, and it has some relevance to New Orleans, which is invest if you can, if you know someone who leads a company, who's a CEO of a company, and you know the person personally, not for some kind of inside tip, but for being able to judge that person about his or her acumen and integrity, that can pay off really well. And I have to say that in my case, it was a guy named Tom Rapier, who's now since been deceased, and Ian Aronoff, who also died just recently, who were the two leaders of First Commerce Corporation, First National Bank of Commerce, which I guess, I don't know whether it still exists or not in New Orleans.
Yeah.
But that was actually the first big score I ever made in the stock market, because I just felt these two guys are just terrific people.
All I could say is I hope you come back.
I would love it. I would love it. I had fun too.
Thanks, Jim. We so appreciate it. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. And now for a look ahead for next week. But first, on January 22nd in 1975, what did this McDonald's franchise create at his Sierra Vista, Arizona McDonald's that became so popular for almost every one of their restaurants? What was it? We'll have the answer in just a moment. Well, on January 22nd in 1975, what did this McDonald's franchise create at his Sierra Vista, Arizona McDonald's that became so popular for almost every one of their restaurants? What was it? The first drive-through. It was near an Arizona military base to serve soldiers who were not permitted to get out of their cars while wearing military fatigues. Now, drive-through sales account for half of all McDonald's sales throughout the world. Well, next week, we've got a great guest on Wall Street Wrap-Up. Have you been thinking about maybe purchasing or leasing a car lately? Next week on Wall Street Wrap-Up, we'll be discussing the do's and don'ts of buying that new car. What type of information are you going to be needing to get the best deal against the car salesman? What are the best made cars these days? And what about those extended warranties? Am I the only one who gets a call once a week asking if you'd like to purchase an extended warranty on my car? Next week, Mike Quincy from Consumer Reports. And remember, as a reminder, we repeat the show on Sunday mornings, but always the best way is to set your DVR so you'll never miss an episode. And that's our show for Friday, January the 21st, 2022. I hope you enjoyed it. My thanks so much to James Glassman for joining us this evening. But as always, we appreciate you for allowing us into your homes tonight. Remember, you can always follow us on all the social media, Facebook, YouTube, Twitter, and WYES.org. So have a great weekend ahead and a productive week as well. I'll see you next week for Wall Street Wrap-Up. I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.